Okay, so we're going to hear from the workshop organizer now, Rama Cont, who's going to be talking a bit more about fire sales, endogenous risk, and contagion mediated by prices. I don't think I need to tell you the rules, Rama, since you wrote them, so 45 minutes, and then hopefully we'll get a good 15 minutes of discussion and questions.
Okay, thank you very much. This talk was supposed to be given by my co-author, but unfortunately it didn't come, so I have to step in. So this is based on joint work with my former student Lakshit Wagalat. These two papers, one which appeared in Mathematical Finance, and ongoing work with Eric Scanning. That will be the last part of the talk. Okay, so I'm going to, so we heard a lot about different mechanisms for systemic risk in this and the previous workshop, and so here I just try to give a short list of the types of things we've heard. So we've seen a different mechanism that can lead to large-scale losses in the financial system. One obvious mechanism, and I think Philip Hartman earlier this week gave a very nice overview, is what we can call systematic risk. That's the presence of common exposures in portfolios, exposures to common risk factors. And here, if we think about the title of the workshop, how to monitor such sources, well, obviously it means what we need to monitor is the concentration of portfolios and concentrate exposures to risk factors, and then also their volatilities and correlations, which give us a magnitude of what impact we can expect on these portfolios. Then we heard a lot about the contagion due to counterparty risk. So we saw a lot of network models which try to capture this balance sheet contagion. So this can be thought of balance sheet contagion through the asset side, where losses in asset value can lead to insolvency, default, and then propagate to counterparties. And here the ideas that have been proposed based on these models has been to monitor the level and concentration of counterparty exposures, and this is underway at many levels. Then we heard about a third mechanism, that is the contagion through liquidity provision and funding relations, and that's what we can call balance sheet contagion through the liability side, especially through short-term liabilities. And here the idea which has been proposed and is being implemented in the new regulations is provisions to make these funding relations stable and longer in maturity. There's also things that we heard a little bit here, but not much in this workshop, and that's related to other mechanisms of contagion, not necessarily market-based, but information-based. I'm not going to talk about that. And here in this talk and in this session this morning, we're talking about what we can call price-mediated contagion. So this is contagion through feedback effects from trading behavior of market participants. And the most egregious example of this has been the fire sales channel. So, but it's not only about fire sales, but here I'm going to talk about fire sales. So this, I think, this last channel, which I'm going to focus on in this talk, is probably the most perverse one, because it can happen in absence of any direct relations between institutions. So contagion from A to B can occur, even though A and B do not have any direct links together. As long as they hold the same assets or the same types of assets, this can occur. So this leads to long-range contagion across portfolios through the price system. And also, since this contagion takes place through the price system, it ignores all the boundaries of institutional boundaries, such as the banking versus non-banking and so on. So here it's really something that is that, for example, ring fencing in the sense of institutional ring fencing cannot prevent, because even though you don't have direct relationships, this price-mediated contagion can occur. So it's really very difficult to deal with, I think, and it involves a lot of issues that are not in the other channels. Okay, so I think the previous talk by Augustin very nicely reviewed a lot of issues related to fire sales, so I don't need to dwell a lot on this. So as we heard in the previous talk, there is lots of empirical evidence that market stress can lead institutional investors to deleverage their positions, and this can be due to various issues for institutions subject to portfolio constraints, such as leverage constraints, liquidity ratios or capital requirements, this can be due to these constraints. So when these constraints are triggered, when the constraints are breached, then the institutions have to engage in some type of liquidation to meet their constraint. But it can also occur in other types of financial institutions, not necessarily subject to those constraints because of investor redemptions, for example, during crisis scenarios when investors tend to exit their positions simultaneously, or it can be due to exogenous reasons. But all these phenomena, whether the fire sale are due to portfolio constraints due to regulations or but due to investor redemptions, they all tend to occur in the same types of scenarios, but scenarios where the portfolio has a sudden loss. So that's the important point in what we're going to say. And examples, I think Augustin gave same type of examples. It's very simple. So an example here, but just to show the magnitude of these effects. So if we start, for example, from a portfolio shown on the left where the leverage initially is 10 and there's a leverage cap of 12, for example, just to show you what happens. And here in this portfolio, we have an asset value which drops by 5%. So if you have an asset loss of 5%, this looks like a moderate scenario, but since the leverage is already 10, this loss is magnified. And then very quickly, the leverage cap is exceeded. So in this example, if we have a leverage constraint of 12, I want to shed assets sufficiently, a sufficient amount of assets to go back to the leverage cap of 12, it means that we have to liquidate, in this case, 35% of the initial asset value. So this amplifying factor of 5% to 35%, that's clearly due to leverage in this example. So in all the examples I will give, and the model, leverage will play an important role. In the same example, if the initial leverage is 1, of course, there's going to be no issue with the fire sales. Okay, so obviously this mechanism is not new. It has been studied a lot in the literature, and it has been understood that this can generate a feedback loop, a destabilizing feedback loop. So in a stress scenario, an initial shock is applied to portfolios, and then this causes fire sales, which impacts the price, and this can lead to more fire sales, and this can generate a destabilizing loop. And the issue here is that when we talk about the fire sales, we think of rapid deleveraging. It's not orderly, gradual deleveraging, which can occur over a long period. That might not have any price impact, actually, if we do it over a gradual, over a long period of time. So we think about this deleveraging done in a short period. That's what brings this price impact. And there have been a lot of studies in the literature. So here I cite some papers, but there are many more. And a lot of these papers have focused on the effect of fire sales on prices. So typically the price will be pushed down by fire sales, by how much, what's the effect, and so on. And there are lots of papers on this. There's a nice review by Andre Schleifer on this. And in almost all of the models, except in Kyle and Xiong, it's a single asset model. So you have one asset subject to fire sales, and you look at what happens to the price, and then you quantify the loss and so on. And but there are other interesting papers. For instance, Adrian and Shin, they look again at a single asset framework, but they look at the endogenous risk that is generated at the macro level when you subject this portfolio, this representative portfolio, to a risk constraint, which can be thought of as a leverage constraint, but a value at risk type constraint. And so let me skip. Yeah, so here I'm going to focus on not only the fire sales as a mechanism for feedback, but also as a mechanism for contagion. So when you look at fire sales as a mechanism for feedback, you can look at this in a model with a single portfolio. There's no need to look at contagion. But actually, but the other aspect of fire sale is that if you look at it in the context of multiple portfolios, it can also act as a mechanism for contagion, and that was what was discussed in Augustin's talk. So I don't need to discuss this a lot here. So I think you saw very clearly how fire sales can lead to contagion when you have multiple portfolios. This happens even in a single period model, as was shown in Augustin's talk. Okay, so Here I'm going to introduce first a very stylized model of fire sales, and then we'll see, and I'll try to distinguish the pure fire sales feedback effect that you could call self-contagion, so the impact of the deleveraging on price dynamics, which results in a loss for the portfolio itself, even without looking at other portfolios. And then in step 2, we'll look at the contagion effect and try to see what are the respective factors which amplify losses in the first step and the second step, and how do they combine. Okay, so here we're going to look at a model with a certain number of portfolios, J institutions with leveraged portfolios, and they have holdings in some illiquid asset and allocations across illiquid assets. And the first step in the model is that there's a stress scenario, and they're correlated to price shocks to portfolios. In the example I will show, in the first example I'll think of a price shock to the illiquid asset, but you can think of various scenarios of price shock. As in Augustine's talk, really we should think of this as the impulse response function type of thing. So we think of the stress scenario, and then the model basically tells you what you get out of it. It's not a model for the shock itself. So the shock itself is the way you think of the stress scenario. So we have a stress scenario, and this stress scenario will lead to an initial loss in the portfolio. And then the second step is, that's where these leverage constraints or capital ratio constraints come in. So in the second step, as we'll see, portfolios whose loss or leverage limits are breached, those are the portfolios which are going to deleverage, and the magnitude of deleveraging will depend on how these constraints are breached. Step 3, exactly as in Augustine's talk, this deleveraging will lead to some price impact, and we're going to have a model for that price impact. And then step 4 is this price impact will affect prices of assets held by other portfolios. So then we have to compute the loss of the other portfolios, and then this is a loop, so then the other portfolios will go through the same loop, and this may result in contagion and feedback loops at the level of each portfolio. And here the institutions are being so here the channel of contagion is clearly that they hold some common assets, they're holding the same assets. So this feedback loop continues as long as losses generate a breach of portfolio constraints in some portfolio, or until the prices hit a level where other investors, a value investor, for example, stoops in to buy. Now, what I'm going to describe here is a model for the short-term dynamics of this type of loss contagion. The model doesn't say anything about this. When does it stop? So it cannot be really transposed to a long time scale. It doesn't make really sense to run it and see who defaults. So that's not in the model. That's the question Rob asked from the previous speaker. Who buys it, when, how? So that you can think of it as some price level where investors will stoop in to buy. That will depend on the asset class. That's very difficult to model here. It's clearly not within the scope of the model. And it could be a regulator which steps in to buy. I mean, that's another issue. Okay, so here I'm going to spend a few minutes distinguishing what this mechanism of fire sales from what has been called leverage targeting in the literature. So there are a lot of papers which discuss leverage targeting as a mechanism for endogenous risk. So the idea of leverage targeting is you assume that portfolios, or the portfolio you're looking at has some target leverage. So it's and anytime there's an asset's price move which moves it away from this target leverage, is going to rebalance, but typically through liquidation or by buying or selling, to return to this target leverage. So that's the idea. Now, so this can be, I mean, this has done nothing to do with fire sales. For example, if you think of large asset managers, they typically will reallocate, they do their strategic allocation on a periodic basis, so they will strategically reallocate the proportion of assets invested in each asset class, say every 6 months or every 3 months. In between two allocations, they will stick to some their target allocation. So This is actually even more detailed than target leverage. So this target allocation will have some leverage. And so every time prices move, they will rebalance, but that's not a fire sale. They can take their time to rebalance. So the mere idea of leverage targeting doesn't imply any rapid deleveraging or any huge price impact. It can be done in a gradual way. So what we're talking about here is really not the same as leverage targeting. And so leverage targeting is really goes two ways. So if prices drop, you have to sell. If prices go up, you will buy. That's leverage targeting. But in the fire sale situation I'm trying to describe, it's really a completely asymmetric situation. If I'm short, I'm below my leverage cap. It's not a target; it's a cap. I'm not forced to do anything in a short time. I can be comfortable with the buffer I have. I don't need to do anything in particular. On the other hand, if I breach the leverage cap, then I have to do something in a short period. That's when the fire sales kicks in. So there's an asymmetry in what we're modeling here, which is not present in the idea of leverage targeting in general. So in other words, here we don't have any fire buy, which leverage targeting implies. So if you look at a linear model, this implies you go both ways. Here we don't have fire buys. Also, in terms of price impact, this has implications. So unless there is a good reason to think that you have to do the deleveraging in a short period, then you're not talking about the same price impact, because the price impact of a trade is not proportional to the volume, but it's proportional to the volume per unit time. So if you do the same volume over 50 days or over 5 days or 1 day, it's not the same price impact. Okay, so then you have to enter considerations of whether it's permanent price impact or transient price impact. So here, I mean, you have to, if you think about the time scale, clearly this changes the whole picture. And the third point is that since we're talking here about leverage caps or limits on capital ratios, well, this means there's a threshold which comes into play. So if I'm away from the threshold, nothing's going to happen, even if there are price moves. Only when I hit the threshold, there's something that's triggered, or at least if I get close to the threshold. So, and that's different also from leverage targeting models, where you assume portfolios constantly react to even smaller price moves because there is no buffer. In some sense, you're always at the target. Okay, so let me say what these things imply in a simple model, a standard model fire sale. So, as I said, we have a set of portfolios. Let's assume each portfolio J has dollar holdings in some illiquid asset and liquid asset. So LJ is liquid, I is illiquid, and some equity level CJ. And each portfolio is subject to a capital constraint or leverage constraint. So you can think of this as risk-weighted or non-risk-weighted, depends on what you want to apply to. And then we have a stress scenario. So again, the stress scenario, you can think of this as you have one scenario and want to see what's the response of the system. So you, in this case, I look at a stress scenario where I apply shock epsilon % in loss to the liquid asset. You could apply both to liquid and illiquid assets. So the reason I distinguish liquid and illiquid assets is, as discussed in Augustine's talk, you can think of the deleveraging as being done in the liquid assets. So the best strategy for me is not to liquidate what has undergone a loss right now, because I'll have a large market loss if I do so. So I'm trying to deleverage something else. So here you could introduce several categories of more or less liquid assets. So here I stick to only 2 categories. So then the leverage, so under this shock, you see the leverage will change. And as in the example I gave, so if the shock is large enough, then the leverage constraint will be breached. And in this case, you can work out very simply that the threshold which activates the leverage constraint is, for the shock size, is this one. So if the shock size, so that's a return, so it's in percentage, is larger than this number, then then the constraint is reached. And as you can see, if you look at this threshold, it's a ratio. So on the numerator, you have the buffer, so how far you are initially, portfolio J is initially from the threshold. So if you're above your capital requirements or exactly at the level of required capital, then this will be small or large. So this is the buffer, and the denominator is the leverage minus 1. So if you're unleveraged, so this is infinite, so this means there's no threshold. You can always, there's no fire sales, and this tells you how sensitive you are to the shock. Okay, so now for each fund where the leverage constraint is breached, you will need to sell some amount of assets, some proportion of assets, and here we assume again proportional deleveraging. If you introduce various categories of liquidity, you could distinguish that. But so you need to deleverage a proportion Fj, which depends on the shock size epsilon, and again you can compute it. And obviously, if epsilon is smaller than epsilon j star, the threshold, there is no deleveraging, as we saw. So it's really a threshold function here, which is materialized in the maximum of epsilon minus epsilon j and 0. So what you see is that the number in front of the threshold function, but depends on leverage. Okay, so there's size times leverage. Okay, so now that's the proportion of portfolio J being deleveraged, and now I have portfolios with various holdings. So let me call alpha ij the allocations of portfolio J in the asset I, and so if I sum now over all portfolios, that's the total volume of assets which being liquidated by these portfolios. And as we see, well, in front of the sum we have the maximal allowed leverage, and then inside the sum what we have is something proportional to size. So the contribution of each fund is proportional to size times leverage, and then we have these threshold functions. So as we increase epsilon, so when epsilon is 0, so probably all these things are 0. As we increase epsilon, we activate more and more terms in the sum. There will be more and more non-zero terms. Okay, so so what we can see immediately is that as a function of the shock size, if you look at the volume of liquidations, xi of epsilon in some asset class I, as a function of shock size, it's always a convex function. Okay, so you add up these broken lines, but these broken lines, actually, you can show that by doing positive linear combinations of broken lines, this type of function, you can actually generate any convex function. So you take any convex function, I can give you weights, that means size distributions of the firms and leverage distributions across firms that realize that convex function. And what that means is that the sensitivity, so to the shock at level epsilon, is increasing with epsilon. So there is an acceleration as the shock size increases. So what you observe, the impulse response you observe to a small shock is not a good indicator of what you will observe for a shock twice that, 3 times that, and so on. So as an example, let me show you what happens so this is just a numerical example. You look at a system with 20 funds with leverage between 5 and 20, and the leverage limit is 25. So they're not very close to their limit. They have a lot of buffer. And that's the function you get, xi of epsilon, when you take a heterogeneous set of sizes. Okay? So what happens is that, so what you see here is a superposition of these broken lines. So each time the shock size epsilon will go above one of the thresholds of one of the funds, I add one of these broken lines. So I just keep increasing the slope. Okay, so what that means is that, and that's the case as soon as you have heterogeneity. If all the funds are identical in leverage size and so on, well, this sum is just this function times one number, so then you have 0 and linear. So then the linear model, the one-sided linear model actually applies, but as soon as you have heterogeneity, you get this convex shape. So this means that the convexity means that, but deleveraging doesn't really occur as in a linear deleveraging model, where it's proportional to the shock size, but rather in bursts. Up to a threshold, nothing happens, and then all of a sudden you have a burst, and then you have a bigger burst and so on, as more and more institutions become prone to fire cells. Okay, so so this is obtained purely by assuming a mechanical deleveraging, where the only thing the institutions do is they react once their constraint is breached, and they just sell enough to bring back the leverage to the cap, but not more. But you can think of various variants on this. I mean, Augustin touched on this. You can think of institutional features, other reasons, and so on. So in general, you will always have this convex shape, but but the weights in front may be different from this number here, because you can have other reasons for having deleveraging. Okay, so in general, that's an inverted way of looking at the same here. If you look at the deleveraging proportion as a function of the P&L instead of the loss, and you invert this curve, it will always be increasing and concave in this direction, or increasing and convex in terms of the loss. Okay, and the slope of this will increase as the threshold increases, because more and more institutions will participate. Okay, now, so this function just gives us the reaction function, the volume of liquidation. And now step 2 is to say what is the price impact of this liquidation. So this is, of course, per asset class or per asset. And so here again, we use an approach that is used a lot in the market for example, computing optimal execution of trades. So it's well recognized in the market that if you execute a large trade, there is a price impact. And so people model this in linear or non-linear way. So the idea is that the price impact is a function of this of the temporary imbalance in demand or supply created by your order, and it can be either nonlinear or linear function of that. So in the examples I show you, I will use a linear function. In the paper, we actually investigated the impact of nonlinearity. There is, of course, a quantitative impact, but qualitatively it doesn't really change the picture. Okay, so if I adopt a linear model, then the price dynamics in the model will be of this type. So every time I have a deleveraging that occurs, so shock epsilon is applied. So the shock epsilon is, of course, applied to the assets. I mean, the shock epsilon is a shock that is applied to the price of the assets. So even in absence of this deleveraging, there is a price move. So there's a price move. You can think of this as your favorite factor model. It can be static five-factor model, time series model. So this is the first term here. And in absence of deleveraging, that will be dynamics of our prices. And then if deleveraging occurs, and that depends on the threshold attained by epsilon, this will be the term that I presented in the previous slide, and that adds a price impact term here. So in the examples I show, I assume it's linear, and the denominator here is the market depth of the asset, or if you call it, in Augustin's talk, you call it amihut liquidity or chi lambda. These are the same versions. Okay. Now, in the empirical examples in the paper, we use this insight from a study by Obijayeva and Wang, where they study the price impact of institutional investors' trades, so-called portfolio transitions through Barclays. So there's a large database where you can see portfolio transition of institutional investors, and they have a lot of data on this intraday, daily. And what they show is that the linear impact is actually not a bad approximation for a wide range of trading volumes. And so that's only on equities. I mean, they only study equities. There's not much data on price impact on other asset classes, unfortunately. But on equities, there's lots of data. And what they show, and I think this is a very good rule for calibrating these models, is they show that, well, price impact is not the same for all assets. You can't assume that lambda is a universal constant, but if you measure the size of the trade as a percentage of daily volume and the size of the price move as a percentage of daily volatility, then in these units, the ratio is around 1, so it's between 0.1 and 3 across all the US equities they look at. So that means, if you look, that means you can think of the volume in terms of percentage average daily volume, and then in that unit, the lambda should be proportional to the volatility. Okay, but the proportionality constant is not huge. It's not 10 to the minus 10 or 10 to the 10. It's around 1. So that means if you want to look at these units, you will get a reasonably realistic simulation. Okay, but it's important that it's the denominator is average daily volume and not market cap. Okay, so it can be an asset can be very large in terms of market cap, but be rather thin because it's thinly traded. So this is a very important point here. Okay, now what can happen in this model? So let's look first at a case of a single fund, but the equations carry out for multiple funds here. So let's see how this operates in the case of a single fund deleveraging. So you have a market stress scenario. So it's like in the previous talk, you have a linear model describing the shock to the portfolio. Epsilon is the shock to the risk factors. The factor loading matrix A transmits this to the assets. The portfolio weights pi transmit this to the portfolio. So you have an overall shock to the portfolio shown in this term here. Okay. So as we saw, if this loss exceeds a certain threshold that is linked to the leverage, the initial leverage, and the leverage cap of the fund, then deleveraging starts, and deleveraging is given by this a response function that I call f, this increasing concave function. Okay, and then this leads to this enables to compute the volume of deleveraging by this fund, and then we insert it into the market impact equation. This gives us the dynamics of the price. So the important thing is that this term cannot be absorbed into the risk factor dynamics in the usual way by adding a trend or something like that, because this term is asymmetric. Most of the time it's actually 0, and it only kicks in when the loss of the fund is large enough. So it's not randomly timed. It's not something that you can absorb as an IAD term or something else. There's a timing issue. This term is non-zero only when the fund has a large loss. So that's it's in some sense a very deterministic type of mechanism that that you're now coupling with this factor model to describing the assets. So. And if you look carefully at what we've done here, in fact, in this model, the dynamics of assets and the portfolio are given by a Markov chain. So you can think of the transitions of the Markov chain in 2 steps. In step 1, I apply an exogenous shocks to assets, so that's the fundamentals. And then in some cases, distress selling will occur if the fund has a loss that is large enough. And if this distress selling occurs, it will generate a fire sales term here. So that's the proportion being deleveraged, and this is so that's the proportion being deleveraged. This is the initial allocation, so that F times alpha is the volume being deleveraged, and in the denominator is the liquidity or the market depth. So this gives us the price impact of deleveraging. So if you look at this, it's a Markov chain. It's fairly easy to study by simulation, and you can say some things about this mathematically. And so let me just start with an example just to show how this works. So let's look at the example of a fund investing in 3 asset classes. So I have S1, S2, S3, and let's assume that these asset classes are driven by independent risk factors. So the epsilons in the equation are independent. And now I look at a fire sales scenario in which the fund reduces its position by 20% over 1 month, and since it's big, this implies that it trades at 10% of the market depth during this period. So these parameters define the ratios in the equation in a dimensionless way. So I'm going to run the Markov chain with these parameters and see what happens. So the question is, what is the resulting dynamics of the price? How am I distorting the dynamics to this fire sales? Okay, so here is an interesting graph. So we take this Markov chain, we simulate 10,000 scenarios, and in this model, because it's a controlled experiment, just a simulation, the underlying risk factors are independent. So if you look at the model with no fire sales and you estimate the correlations across the asset classes, it should be 0 within the statistical error. So this is the realized correlation. If you look at a simulation over 250 steps, so think of it as 1 year of data, and you estimate the realized correlation. So in absence of these fire sales effects, you get indeed something centered around 0, and this is the error bar. Now, if you look at what happens in this model, this is what you get. So this is the this is the distribution of the realized correlation across 10,000 simulated scenarios. Clearly, there is something going on. There is a shift, systematic shift to the right. And this means that you have a systematic increase in realized correlation, and that's entirely due to this new term. So it means that in the scenarios where the fund is deleveraging, well, in this example, it's a long-only fund. So deleveraging means they sell simultaneously 1, 2, and 3. This creates a systematic term, but due to price impact, but this systematic term goes in the same direction for 1, 2, and 3. So even though they're not fundamentally correlated, this creates a correlation which occurs, which is realized in the fire sale scenarios only. And indeed, if you now condition on the liquidation, so if you now zoom in on only those scenarios where fire sales occurred, so in these 10,000 scenarios, there are a few of them where fire sales occurs, but if you condition on that, then you see that the conditional correlation, which is really what's important, because when you diversify, you want to diversify against risk. So you care about only the scenarios where large losses occur. But unfortunately, in those scenarios where you want diversification to work, it works less well because the conditional correlation is around 30%, starting from 0 fundamental correlation. So this means that you're actually, this term is not just about an impact on price levels, it's changing the dynamics of the market in a way that it increases the realized correlation, it introduces conditional correlations, and this is starting from a model with constant coefficients. So you really don't need a complex model to start with. You introduce these heteroscedasticity effects, but conditionally on the fire sales, but without any other mechanism. Okay, obviously, if you increase the correlations in these stress scenarios, you're going to increase the fund volatility. So if you look at fund volatility, the expected fund volatility in this constant coefficient model is the one shown here. It's around 20%. The realized fund volatility is shown, well, it's the scenario dependent. This is the distribution of the realized fund volatility. And clearly, again, you have a skew to the right. So you see that the fire sales term increases, exacerbates fund volatility, and it can do it by factor 3 or 4 in some cases. So what we see in this example is that even starting from a constant coefficient model, well, everything, all the coefficients, including the liquidity, the covariance structure of the factors are constant. The fact that you have this threshold introduces some phenomena which viewed from an external observer seem to be heteroscedasticity, spikes in correlation, things like that, associated to fire sales. But this is really all is included in this feedback mechanism. You don't need to explicitly introduce any time dependence here. Now, is this specific to this example, or is it more general? Well, this Markov chain model is really hard to study. So to understand this, we move to the continuous time limit, because that's an analytically tractable framework in which we really see what's going on. So just to recall the ingredients, so F was the deleveraging schedule, the reaction function of the fund to a shock, and then alpha is the size of the position in of the initial position in the fund. Lambda I is market depth. So alpha I times the slope of F divided by lambda I, that's the quantity which will play a key role, is really the fraction of market depth but generated by these fire sales. Okay, so this is the participation rate I have during the fire sales. And the pi I are the dollar allocations. Okay, so now what we can show is that if you start from this Markov chain model, and if you look at the continuous time limit, so in some sense you iterate these fire sales or you execute the fire sales through many small orders over time, what you see is that this converges to a diffusion limit. And if you had no fire sales, this diffusion limit would be Black-Scholes, because you have an initial, a covariance structure, some drift, all are constant. So if you just rescale time, it converges to Black-Scholes with drift with the trend mu I and then some volatility structure given by the factor loadings Aij I had in the discrete model. However, the fact that we have fire cells here introduces a distortion here. So you can see in the continuous element very clearly that you add an extra term to the trend. And in this parameterization, so f is now the reaction function as a function of PNL, f is concave. So f, the second derivative will always be negative. So this is a negative trend. This is understood, well understood. It's just a continuous time manifestation of the well-known thing that fire cells will push the price down. Okay, that we understand that. But okay, there's some structure. You can see that there is this second derivative. There's negative term here. And also it's proportional to alpha I over lambda I, meaning that that's the volume I'm deleveraging, but divided by the market depth. So clearly the size of the position relative to market depth is what determines the amplitude of this term, and that's the portfolio volatility. Now what we also see is that the factor loadings change. So the factor loadings, which were initially Aij, now they have an extra term here, and this extra term is very easy to understand. This fraction here is just the volume due to deleveraging divided by the market depth. So alpha I times slope of f is the volume, and lambda I is the market depth. So again, the fraction of volume generated by market depth will determine the magnitude of this extra term. Now, since we have this explicit form, now we can compute a lot of things here. So for example, we can compute the realized covariance during the fire cells episode. So in absence of fire cells, the realized covariance is in this model is a constant matrix. You can complicate this. You can put some heteroscedasticity here. So this is what you expect from your historical data, from your empirical covariance. But in fact, in the fire cells episode, you will have a temporary increase in the realized covariance, and this is due to these red terms here. And the red terms all have the same structure. It's always the volume of the fire cells in asset J by divided by depth of J, the volume of fire cells in asset I divided by depth of I, and the other a term with the factor is the contribution of asset J to volatility, the contribution of asset I to volatility of the portfolio. Okay, so what you see is that these extra terms, these excess covariance terms, these temporary excess covariance terms are proportional to the size, but in terms of market depth, and they're proportional to the inverse of the liquidity. So if you, the less the liquid the asset is, the higher this ratio is. And also it means that, for example, if you look at the covariance between asset I and something illiquid, some illiquid asset J, this will increase more during liquidation than some other very liquid asset. And in fact, we do observe these things. So this is an example we develop in the paper. If we look at the fire sales episode of fall 2008, we did observe a huge ramp in the correlation. This is just equity correlations in two indices, SPDRs and the Eurostock. So these are two different markets. And you see a simultaneous ramp in the correlations as if somebody was synchronizing these things. And clearly, these are not random effects that you can account for as outliers of some model. These are very, these ramp-ups start at a specific date, and they are nearly synchronized if you look at these two markets. So 10 minutes, 5 minutes?
5.
Okay.
If we're going to have all questions.
Okay, let me skip. So this framework can be used as an estimation tool for forensic analysis fire sales episode. I will not talk about that here, but we applied it, for example, to the great deleveraging of fall 2008 to estimate what kind of fire sales portfolio can explain this kind of ramp-ups you saw in the actual covariance structure. So I'm not going to go into that. But here I'm going to finish by speaking about what this implies for spillover. So since we changed the structure of the layer of since we're distorting since the fire sales distorts the price dynamics in this period of fire sales, anybody else holding the same assets will experience a heightened volatility and a change in the trend of the assets. And since we know the diffusion dynamics of the assets, we can compute exactly what another portfolio with weight beta I is going to experience during this period. So the drift being linear is clear, it's easy but to see that this portfolio will develop a drift, which is the scalar product of the excess drift we computed and the weights of the portfolio. And it's also easy to compute using the explicit form of the realized covariance that this portfolio is going to develop an excess conditional variance that is again explicitly computable. And what's interesting is that these excess covariant terms are proportional to this scalar product, which appears in all terms. This scalar product is the scalar product of the portfolio we're looking at, the portfolio that is being deleveraged, but it's not the ordinary Euclidean scalar product. It's a scalar product weighted by liquidity. So if you look at it explicitly, this term is exactly, I look at the portfolio being deleveraged, pi, I look at my target portfolio, so the spillover from pi to phi will be proportional to this overlap. It's what we call the liquidity weighted overlap. So, and that's what is dominating contagion in these stress scenarios, okay? So now this leads to an interesting discussion. First of all, if that's what was evoked by in the previous talk when discussing the diversification. So that's where if portfolios are diverse in the sense that these scalar products are zero, if they're all orthogonal, for example, there's actually no contagion. Okay, so you have a set of orthogonal vectors with respect to the scalar product. There may be actually no contagion occurring, even if everybody is doing fire sales. There's self-contagion. They're going to affect price dynamics, but this price dynamics doesn't transmit any loss to the other portfolios unless this is non-zero. So this means that one way of looking at risk factors or concentrations as far as fire sales is concerned is to do a liquidity weighted by PCA on portfolio holdings. This is going to tell you which directions in portfolio space are prone to fire sales and which are not. So the eigenvector with highest eigenvalue in this metric, not the L2 usual metric, is going to give you the primary factors in a macro fire sale scenario. Now here, so now if you put these things together in a portfolio in a model with many portfolios, it's very hard to say anything concrete unless you assume something about the structure of the portfolio. So I'm going to end with that. So here we look at a market where portfolios are not random, but they are aligned along the benchmark index. So the portfolio, you can think of it as, so I as a benchmark per portfolio, and I think of the institutional portfolio J as some proportion invested in benchmark plus epsilon J, where epsilon J is the difference between my allocation and the benchmark. And epsilon J is not necessarily small, it can be huge if I'm really different from the benchmark. Now in this model, then you can see that the overlaps are given by clearly the proportions invested in the index or the benchmark. And these things will represent the diversity of allocation. So the phi J's can be all diversified in their own way, but if they're aligned with the benchmark, that's diversified but not diverse. So epsilon J is the diversity as opposed to just diversification. Now, and this, so it's easy to see that in this model, if you look at fire sales risk, there's a competition between diversity and diversification, and this is a topic that has been discussed in the systemic literature. So on one hand, the diversification of portfolios reduces concentration in a given asset class. So that reduces the price impact of fire sales in the deleveraging phase. On the other hand, diversification increases portfolio overlaps, so increases the magnitude of contagion to the fire sale in the second phase. So the result is a non-monotonic effect of diversification on systemic classes. And in this model, diversification, you can capture it by varying this coefficient kappa, the loading on the index. So let's look at two extreme cases. If portfolios are segmented completely, so each portfolio is invested in one asset class only, then of course there's no contagion, but the impact of deleveraging is maximum because everybody's concentrated on one asset class. So there's no contagion, but there's still a lot of systemic loss in case there's a shock. If portfolios are, on the other hand, fully diversified in the same way, so think of the CAPM type model, so they're only invested in the benchmark funds, then the impact of the initial shock will be diluted across many assets by diversification. But, so this will diminish the price impact, the self-contagion in the first step, the endogenous risk in the first step. But if somebody will reach their threshold, so that can be generated by high leverage, so they can be diversified but highly leveraged, then there is a likelihood that some portfolios will reach their threshold, and that will generate contagion in the second step because they're very collinear. So that's shown in this figure. So this non-monotonic effect. So what you see is that if you change the value of the diversification, the diversity coefficient kappa, so this is the degree of alignment on the benchmark, and if you vary the shock size, the epsilon shock size that you apply initially, actually for small shock sizes there is no impact, there's no contagion, no endogenous risk, because nobody hits their threshold. For small shock sizes, actually the loading on the index will help, because if you increase, if you increase the amount invested in the index being fully diversified, actually you will decrease the price impact due to deleveraging. The volume of deleveraging will be spread across all assets. So in this case, the sum of the capitals at the end of the cascade, so this is 1 minus the systemic loss, sorry, it's a crazy figure, this will actually be more helpful. But if you look at large shock sizes, it's the opposite, because large shock sizes will likely trigger a deleveraging large enough, even accounting for diversification, such that there is contagion to some funds in the second step. And as soon as contagion kicks in, it takes over. And then what you see is the opposite dependence on diversification. So it's not so simple that diversification is bad or good. It really depends on the shock level. So that's what I'm trying to convey here. And in fact, this can be used to calibrate. So assuming that you believe in this model, you have the data to feed in this model, this can be used to calibrate the limits on leverage, but depending on what type of severity of stress scenarios you're thinking about. So what we can show is that for a given level epsilon max of shocks, if you think about a given stress scenario size, there is a critical leverage ratio cap in this model, such that if leverages of all portfolios are below that level, then no contagion occurs in a stress scenario with shock levels smaller than epsilon max. So this doesn't mean no deleveraging occurs, but no contagion occurs after the step of deleveraging. So that's something that you can look at in the model. So here's an example. You have here what we have is a leverage, and you can, so in these examples, in one region there's no contagion, and the other region there is contagion. So in these examples, what you can see is, if you put a leverage cap here, then there's no contagion in the region above this curve. And that depends on the portfolio holdings. So you have to have some idea. You don't have to have detailed portfolio holdings, but you have to have some idea akin to the type of data you saw in the ABA stress test. You have to have some idea of the holdings across asset classes in portfolios. So I guess I stop here.
Okay. So questions?
It's rather a remark which applies both to your contribution and the one presented by Augustin, which is due to the fact that in this liquidity spiral, what is playing an important role in the contagion is the fact that institutions also raise haircuts or margin calls. So it's not due to the fact that they have correlated portfolios, but that they have also exposure vis-à-vis other institutions, and therefore, here you can have another form of amplification which is different. And in terms of regulatory response, the issue is that it's not necessarily capital or solvency which is the problem, but really liquidity. And therefore, the policy responses will be very different. So I wonder whether...
Oh, yes. So here, for example, as you say, the driver which triggers the fire sales may not be necessarily a loss in asset value. It can be a margin call. It can be other things. I mean, I'm not trying to pin down one cause, but here I see the margin calls or the temporary demand for liquidity shocks as a driver, as a trigger, rather than as a metric for quantifying the loss. At the end, if it was a temporary liquidity issue and it went away, well, you know, that's not what you're worried about. What you're worried about is whether this might lead to a phenomena which causes a permanent impact, or at least a long-term impact, or even a medium-term impact on the values of portfolios, because that can drive them to insolvency. So here we're not modeling the insolvency because we should look at the whole capital structure. As in Augustin's talk, this is just, we're looking at a short-term effect, and this obviously I see it as a building block in the larger stress scenario model. But I think that I see what you say as a trigger, and then we look at the lot losses in terms of the.
Okay, question here in the front.
Thank you. I'd like to explore the differences between this paper here and the paper with Shin and Danielson. So there we have multiple assets also, and we have endogenous correlations, and we get pretty much the same results you have. So my question to you is, the differences I can see is that we have optimally chosen portfolios to start with. So people are rational, they're forward-looking, the portfolios are not just given, they are chosen rationally. And then people know that there will be fire sales, so the rational expectations equilibrium means that they know there's going to be fire sales, and they will liquidate optimally knowing that there are fire sales. And it's all, you know, there's a fixed point between beliefs and then what happens in the market and so forth. So is what your model is much more general because you can, you know, do many more things because you're not fixed to a rational, sort of optimal behavior sort of thing. So my questions are, you guys are liquidating a fraction of their portfolio, but they're not necessarily liquidating optimally, or they may
What
be.
does optimally mean?
Optimal means knowing the impact that the trades will have. Maybe it's not optimal to liquidate a fraction. Maybe you liquidate some assets first and then others later.
Well, I mean, that's a good question. This model of price impact is actually taken from what people do in optimal execution of trades every day. All trading desks have a model like this. We're running for optimal execution. But the decision how much to sell or buy, that's not taken by the guy doing the optimal execution. Somebody has a portfolio strategy upstairs. They do allocations. They decide to shed this asset because of capital constraints and so on. And then this order trickles down to the trader who does the optimal execution. So these are two different issues. So here, you could assume that the liquidation is done in a different way. I mean, I'm not even saying how it's done, really. You could assume the execution is done in an optimal way. Okay, this will diminish a little bit the price impact, but I don't see exactly how.
The guy who sets the portfolio up doesn't think through the fact that there may be liquidations later on, and maybe he would have taken a different portfolio in the first place had he known in a crisis.
Having known what? Having known what?
Pardon?
Having known what? I mean, they don't have access to other people's portfolios. You can't really know.
The guy who chooses the portfolio, you said, may not be the guy who's liquidated in a crisis.
Yeah, of course.
I'm just figuring out, is the difference between your model and our model, the fact that our model is rational in the sense that the guy who sets the portfolio also takes into consideration that if it has to be liquidated,
yeah, so you're saying, okay, so you're saying, yeah, I understand. So let's, so if I know all these things, maybe I should actually change my allocation and even my accounting to account for liquidation cost, ex ante, and worry about whether I'm accumulating, liquidation costs by allocating this or that way.
And this will be reflected in prices in the first place.
Exactly. So this is a good idea, and that's a proposal for changing the risk, the way risk calculations are done, changing the way accounting is done. We start from the premise that this is not done. I mean, but today people don't mark to liquidation. People don't really, they mark to market. They don't take into account liquidation cost seriously in risk metrics, in risk management. So I mean, there's some ideas about that, but typically this is not. I mean, if you look at fund allocations, large funds, do not allocate based on liquidity. They allocate based on some kind of risk versus return. There's no serious discussion of this. So if that were the case, yeah, I would. So this is really trying to capture what, so we're not assuming where the portfolios come from, but I don't think in large institutional investors allocate in a way which precisely accounts for this.
We take one further question or comment from the back of the room. And the first hand I saw was
Okay,
Michael Dempster's.
During the crisis, there was much in the press about contagion across asset classes, with the most liquid assets being sold and that creating fire sales in those and so on and so on. Is that captured in your model with the market depth parameters?
Yeah, I mean, in this model, that's the point. The point is you have a shock to the illiquid asset, think subprime, okay? And initially, many people said, oh, this subprime market is, 500 billion at most, even if you include, not only subprime but other mortgages, it's going to be contained. We can, it's not going to affect the whole U.S. economy because the numbers are big, but okay, they're not. And in fact, it spread to a lot of other asset classes. There's an interesting study, for example, by that there's an interesting empirical study by Francis Longstaff where he looks at the correlations of different asset classes, subprime as represented by the ABX index, for instance, and the S&P, the bonds, the U.S. Treasury bonds, and you can see that these things were negatively correlated up to 2006, and the correlation switched sign during the crisis. So there was a contagion from this asset class, and this kind of model really explains that contagion through this realized covariance thing. You see that things which were not correlated were not connected. So if you look at this, so you see that if things that were, I can start from a covariance of 0 between I and J. The black term can be 0, but simply because of the fact that the portfolio being liquidated here will contain both I and J, these terms will build up and will be non-zero. So I can have an impact of I on J purely due to liquidation, and this is temporary. It only lasts during the liquidation period. So that's really one of the main points in the model.
My question was, that it's captured really in those market depth parameters, is it not?
It's captured in the market depth parameters.
So Rama, it's your workshop. Do you want to take another question, or do you want to finish sort of roughly on time?
Whatever you like. Maybe Nicholas?
So I think you are next. Yeah.
Yeah,
Okay,
I mean,
final question.
this raises something that I've been musing on for a while, which is under what circumstances, if any, should the authorities step in to try and reduce correlations? Because these temporary correlations in crises can actually have very nasty knock-on effects, especially if you have mark-to-market accounting. I don't think there's a simple answer to this, but I think that your paper begins to unpack these questions, and I think it's one of the points that's going to have to be thought about over the next 10 years.
I mean, in this specific mechanism, your question is more general, but in this specific mechanism, clearly it's an issue of price impact. So, I mean, there are two factors contributing. There is this diversity, which is a factor of contagion or not, and there's price impact. So the price impact, you can have the same deleveraging extended over a longer period. This mechanically decreases the price impact because in this model, the price impact is really about the speed of deleveraging rather than the total volume. So if you assume that you can, if you allow this deleveraging to take place over a longer period, then this diminishes the effect. Also, what we see is that all these effects are proportional to the distance, the initial distance of portfolios to their leverage cap. So if portfolios operate close to the leverage cap, then this will be triggered more frequently. If not, the two instruments which I see that somebody like a regulator, the two knobs you can turn here are the way you deleverage, I mean, the constraints on deleveraging, allowing more time during a crisis period to deleverage, and this is something that we've seen discussed a lot. And the other thing is the initial leverage, of course. So the leverage cap here is important, and that's everything is proportional. All the red terms are proportional to the leverage, just as in Augustine's talk. So there's no surprise here.
Okay, so I think we'll draw things to a close, also bearing in mind that we have a long discussion session this afternoon. We start again at 11:30, but let's thank Rama for a fascinating talk.